Hello, this is Eric Boyce, the CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for April 9th of 2023. Please see our disclaimer for important information. In our first chart of the week, we'll talk about what's going on with the Federal Reserve and the banking industry and how things are really kind of calming down a little bit. On the left-hand side, you have the Bank Term Funding Program, the BTFP, which was set up in the wake of Silicon Valley's failure. You see borrowing against that facility has actually gone up over the last several weeks following the Silicon Valley episode. Not to be too terribly worried. Units of measure are very important here. So if you look at the left-hand column of that, you can see that the total borrowing is getting close to about $80 billion. And if you look at the right-hand side, you see the borrowing at the Fed discount window has actually gone down. And so what we've seen is basically a commensurate offset in borrowings against this bank term funding program and the Fed discount window. We've talked about this a little bit over the last several weeks, and that's been the rise in money market mutual fund assets. It's an issue that, particularly with some of the brokerage firms that also have banking operations, like Schwab, you see, some what they call disintermediation, where these balances are coming out of basically these sweep accounts that are then kind of defaulting to the Schwab Bank, and they're going into these money market mutual fund assets, which are not banking products, they're investment products. And so you see, because of the yield differential right now, and a lot of banks are still below market rates on their crediting deposit rates. And so as a result, you see these funds coming out of bank accounts and then going into these money market funds that have higher yields. And so not too terribly surprising. You've seen here, particularly in the last month, 2 months, 3 months, where you've seen a real strong trend into money market mutual fund assets. Looking here at the Fed cycle, we have change in bank deposits in the pink line, which is kind of at the top end of the scale. And you can see, this is a chart from Fidelity that kind of plots this to February 19th of 2020, which is really kind of, a good marking point for the pandemic and the eve of the shutdown, literally less than a month prior to that. So the start of COVID, as it's recognized here, is in February 2020, and you see rise in bank deposits. Some of this had to do with some of the stimulus payments. And not too surprisingly, when you hit an economic downturn and you have people spending out of savings because current incomes are lagging, that you would expect to see bank deposits go down. And so that's where we are now. You see this is all superimposed against the change in bank reserves, which is that middle line, and then change in money market fund assets, which we just talked about. You can see that that's going up at the same time that bank deposits are going down. So this dynamic has been, definitely underway for a number of months now. See down at the bottom of this chart, you have the Fed tightening cycle, and where those rates were fairly low for a considerable amount of time. Rates went to zero during the pandemic, and you can see the meteoric rise in those rates at the same time that bank deposits are going down. And so this is just to kind of reiterate what's been going on in the banking sector with rates moving higher. So investments that are being made when people get deposits, they have to be smart, and they have to realize, well, what is going to go down in value with a rise in interest rates. And that's where Silicon Valley and some other folks got caught unawares when they should have been aware the entire time. Here's a quick chart on the Treasury inflation protected security, otherwise known as TIPS, versus headline inflation. So this is a chart that shows you headline inflation in the amber and this kind of purple line. You can see where it is coming down. We continue to expect further declines. You can see where the TIPS price is now. That's in that black line. And so March 23rd, again, a little bit dated, but still relevant, about 3.14%. So TIPS This is a kind of a bond market's representation of where it thinks inflation is. So this break-even inflation point, if you will, is expected to kind of migrate down to around 3, and then eventually down to 2.35% ish. Here's a probability of a 25 basis point rate hike. And a lot of speculation now in the wake of this banking crisis, if you will, what the Fed is going to do next. And I think things are settling down. We did see in that chart where, borrowings at the Fed discount window have gone down, even though the Bank Term Funding Program uh, borrowings on the part of banks has gone up. But I think if you look at global central banks, New Zealand for one was, kind of surprised the market a little bit with a 50 basis point increase. You've got, kind of a mixed bag out there, and so I think it's not unreasonable to assume that the Fed, in their May 3rd meeting, is going to raise rates another 25 basis points or a quarter of 1%. But that probability is not solid. You can see here that it's actually below 50% right now. I do think it is in the cards from everything that I can see right now, but certainly the probability of a half percentage point rate hike is fairly close to zero at this point, pending new developments in the market. But the feeling is, we have, some of this manifestation of higher rates kind of filtering through the economy. We've got some data that is slowing. We see what's going on in the financial sector, and I think the Fed would be wise to signal some type of a pause, perhaps after this rate hike, to give some time to kind of analyze what the effect of these rate increases has been. And we all know that these rate increases tend to work at a lag. So, we've had so much rate increase over the last year that, now as we head into the summer, we're really going to understand what the impact of that is. Here's a quick look at the Atlanta Fed, their GDP Now index, and how it has progressed for the first quarter estimate, which we will get in about 2 weeks. And you can see where that at the end of January was looking fairly anemic, and then the estimate went higher, and now it's gone back down again. Of course, all the things that are going on in the world, some expectation that we were looking a little bit better as we kind of went into February, and we saw a lot of speculative, influence in the markets, in the investment markets in February, and then that has kind of reversed as we hit this turbulence related to Silicon Valley and the banking sector. And so, we're looking at kind of base case right now for this Atlanta Fed index about 1.7% for first quarter economic growth, which will represent a downtick from the fourth quarter, and I think it is going to presage slower growth as we hit the middle quarters here of this year. And you can see the components here that really, even though we've got net benefit from consumer spending, that benefit is going down. We see the negative impact from private investment, and then government spending and net exports still positive in the wake of what's going on with the US dollar right now. Here's a global manufacturing PMI, and so I want to emphasize global, so it's not just the US. And then this is in the orange line here, and then it's superimposed over the MSCI World Stock Index again. So this is a global equity index overlaid with a global manufacturing purchasing managers index, and you see the correlation here fairly strong. You see the two gray shaded areas, excuse me, three. Those represent recession periods. You can see that those trends typically get really weak as you're heading into those recessionary periods, and we are kind of treading around the midline, even though we see global manufacturing, which is this particular data series is advanced 3 months. It is picking up a little bit, although the last reading was still down, and it is still below 50, which represents contraction. And so with that, it's pretty easy to see why, with this type of correlation, why the global equity index is down. Now, here is a U.S. ISM number, Institute of Supply Management, their Manufacturing Purchasing Managers Index, the PMI. You can see how that oscillates over time. This is superimposed with recessionary periods that go back a fairly long way. And so this week we got the latest reading of the ISM. And so I put Jim Bianco's note in here from his Twitter. So we were at 46.3, which again represents contraction. It's below 50. It's the lowest since we saw since the pandemic and the kind of the shutdown when we were beginning to emerge, and some states were emerging from the shutdown. And then, so this is the 16th time. I thought it was important to get this statistic right. 16th time that the ISM has been at 46.3 or lower. And 75% of the time, the economy was either in a recession or about to enter one. And I think, this is all kind of like consistent with this thought of where we are in the economic cycle right now. And I think this is, it's not an absolute certainty, but we have a strongly inverted yield curve. We have leading economic indicators that have been consistently weak for a number of consecutive readings now. And then you've got this, and then you have, I think, the prospect of maybe a global earnings recession of some measure, and so I think it's widely presumed that this is on our doorstep. Although I will say that this is in all the years I've been doing this is the most anticipated recession in modern history. Here is another look at the ISM number, and you can see where it's trending down. You see on the right-hand side kind of the summarization of these components. New orders were production, employment, supplier deliveries, and backlogs were also down. Now, some of this is good. Some of this not as good. Backlogs obviously were pretty high in the wake of the supply chain issues. Those with reduced demand have largely kind of worked themselves out. Container shipping pricing is down below pre-pandemic levels, and a lot of that has been taken out of play here. Inflation down too, we know that, but again, this is very symptomatic, I think, of what the Fed is trying to engineer. Again, PMI this ISM PMI number has been coming down for a number of years, and I used to say, we'd have readings that were above 60. That is extraordinary, and it was just a matter of time because that level of growth and economic expansion is largely unsustainable, and we're seeing the manifestation of that mean reversion now as we're now a little bit negative for a while. Here's a quick look at job openings. We know that they have been trending lower. This is a good picture of how that is playing out. This is a chart of construction spending, total construction spending. You can see that it was just slightly off in the last reading, and this number does kind of bounce around a little bit, but when you're in economic expansion, you would expect to have many more readings that are up rather than down. You see the trend line has been largely positive with some hiccups along the way. 2018 was fairly notable in that regard, but you do see the data beginning to flatline a little bit. And again, this is U.S. total construction spending. The next chart relates specifically towards residential. On residential construction, we have a clear decline. You see this down around 5.7% on a really a month-over-month reading. You can see that number has, for the most part, been trending lower consistently over the last year, and went into negative territory as we exited last year, and that number continues to be weak, even though the rate of decline has kind of attenuated somewhat, but you can see that in the blue line up above that we've really rolled over in residential spending. Here's a quick look at personal incomes, and you see here that personal incomes are still very modestly positive, and it gives you a look in the amber line, which is the kind of the periodic change, and then the blue line represents the aggregate chained index here for personal income, and you can see that people are continuing to spend, continuing to consume, but that number is slowing down. And on the labor front, which obviously impacts the spending side of things, you've got the Challenger U.S. job cut announcements, and these are for mid to large firms for the most part. You can see where that has kind of fish hooked higher, even though we've had a little bit of oscillation over the last couple of readings, but it's still above a longer term trend line and consistent with what you'd see in a kind of a modestly contracting economic environment. And then concurrently with that, we have the NFIB, the National Federation of Independent Business, Small Business Hiring Plans Index, also moving lower. So you look at the labor market beginning to soften up, would expect to see wage growth begin to soften up as well. Again, nothing terribly surprising here. This is everything that you would expect. This is what the Fed is actually trying to engineer to some degree. And we'll just obviously continue to watch this as we expect employment levels to begin to soften up here a little bit. And on the labor front, as we prepare to exit this topic, we have the Challenger gray numbers here. And the reason behind it. And I think this is very, it was important for me to show this in tandem with the prior slide, because not only are we having these job layoff announcements, it's the reason why we're seeing this. This is not cost cutting, people trying to necessarily, engineer a certain earnings number, as much as it is this demand downturn, which is in that blue bar. And you see that as we've kind of, looked over the last year, that influence has become much more prominent in these decisions to trim headcount. Cost cutting is still a factor. Obviously, when your profits are lower, you're doing everything you can to try to prop up your margins and prop up your earnings as much as you can. But clearly, the demand side is providing an influence into the labor market. Quick look in on consumer spending, and we did see that number, consumption number, a few slides ago was still positive, but very modestly so. And I think this is a foreshadowing slide, if you will, and you can see here total card spending, and then retail outside of the automotive sector. You can see that has been negative here for a couple of weeks. The total card side of it has been negative here for about a month now, and you can see here that X auto, that's been negative for probably a couple months now. Now we'll move into the investment markets and talk about this a little bit. So here we have a chart highlighting retail investor purchases, and back in February, we were at really an interim peak here. We had a lot of investor interest, a lot of technology investment interest. You can see the retail flow spiking there in that light blue line. You've got the S&P 500 in here, and you can see where the S&P, at least from year to date, has kind of bounced around a little bit. And but the retail flow has really dropped off a cliff here, and I think this is notable because it means that the current market is not only is it kind of limited in breadth, and we'll see this in a second, but it's also limited in terms of stock demand because the retail investors largely been silent here over the last few weeks. Just a cap on the last slide, the retail investor interest having gone down, I think does create a little bit of risk, or maybe the possibility of increased volatility over the near term, because you don't have that demand driver coming out of the retail investor side. Here we're looking at sales. So this is a 12-month forward, looking forward sales per share. And then you've got that's in the black, and then in the purple you have the trailing 12-month number as well. And you see that continues to move higher, even though 2023, actually in the third quarter of 22, that softened up a bit, and we're still moving higher. So we still have sales that are expected in the pipeline. Now that could change, but right now the sales forecast is really not that derogatory. Now, looking at earnings, on the other hand, and again, this, just like we saw a few slides ago, we're looking at a global number. So as we look at, U.S. and the global backdrop, and I think we do see the potential here for earnings recession. You can see how this number has moved up and down. We have the global EPS growth in the darker line there, and that's pulling that number 12 months forward, and that's a year-over-year number. We can see that that is now negative, and then you have this slide is from Bank of America's Global Investment Strategy Research Department with Savita Subramaniam, who I have a lot of respect for. Their global EPS model is now looking negative to the tune of about 16%. I mean, all the shops out there, Morgan Stanley, J.P. Morgan, et cetera, have their own models, but they're all pointing into this same direction, that we've got earnings contraction on the doorstep. Speaking of the S&P 500 here, we've got a quick look on a couple of indicators that I think would suggest that while there is still some upside appreciation potential here, that it may not be as robust. And on the upper end, we've got the equity risk premium, which is the earnings yield, which would be earnings over price, minus the 10-year Treasury yield. And we know that that's moved around a little bit. And even with Treasury yields coming down, we also see that this equity risk premium has gone down too. And so I think a number where we're at now is kind of almost, I'll call it like a non-committal zone. So it's not telling you that it's a buy signal, but it's not telling you that it's stocks are terribly attractive at this juncture. And then the slide down below just gives you a 12-month forward S&P 500 excess return over the Treasury given the current environment. So we're about in that equity risk premium level. It's we're right at 133, so it's in that 100 to 200 band. You can see that number is being highlighted for you there in the dotted lines, and so it shows you the incremental return is fairly modest, about 3.6%. Continuing on the earnings theme, we have a chart here, two charts actually, on the rise of negative earnings guidance and number of companies in the index as reported to us by FactSet. See that number is moving higher, not too surprising. And then you see at the sector level down below, maybe a little bit hard to read where that negative earnings guidance is coming from. And honestly, if you look over on the far left-hand side, if you can't read that, I'll just tell you who it is. Information technology is clearly the largest, both on the current setup as well as a trailing 5-year, and then you've got industrials that are right behind that, and then consumer discretionary, which is comes in third there, and so it trails off with really financials, utilities, and energy in these lower baskets here. But clearly, technology has been a large source of these negative earnings revisions. Now, this slide is a bit technical in its orientation, and so requires a little bit of explanation here. And so this is what they call the Zweig breadth thrust, ZBT. And so it's a measure of advanced decline. So the number of positions within the index that are moving up versus down, and it's kind of a relative index where you get like these large inflection points where you get these breakouts. And so you see these dots put in here representing these inflection points in the advanced decline ratio. And so we just got another trigger where this number inflected. And so you can see here Ryan Dietrich, who's a certified market technician, CMT. Again, this is a very technical type analysis. And I'm not terribly technically, I'm not technically uh, oriented as an analyst, more fundamental, but this is telling too. That it's happened 14 times since 1950, and the S&P was higher a year later in every one of these instances. And we just showed you this slide over the incremental return over the Treasury because of where the risk premium sits right now, and so we do expect the S&P to perhaps be higher a year from now, again, treading through this recessionary period as mild as we think it will be. But this would tend to suggest that there's more return in the offing for the S&P, and it's the truth lays somewhere in there. But I think the bottom line, kind of thinking and taking stock of these last two charts, would tend to lead you to believe that the equity markets are going to be higher a year from now. As we continue to look at the equity markets, we see dividends per share continue to move higher for the S&P 500. We see the growth rate might be stalling a little bit, but it remains positive and it remains above the long-term trend line if you go back several decades here. And so, this is something that gives me great comfort in looking at, as we analyze where we need to be positioned within the equity markets. And dividend growth, dividend payers, capital strength. These are all factors that tend to perform well when you're in a pre or concurrent type market with recessions. And clearly here you see companies are still paying dividends. Here's a look at Apple and Microsoft. We've got two companies here with market caps that are above $2 trillion. And the irony of this, and I wish Charlie Bolello had this overlaid, but his comment in producing this chart was that the combined market cap of Apple and Microsoft is essentially $4.3 trillion. Which eclipses the entire market cap of the Russell 2000 by about $2 trillion. It's pretty amazing. And this is a chart from Arbor, which I think kind of highlights what's going on. You see, this is a kind of a testament to the quality factor here. So you've got the S&P 500 in blue, and then you have these companies that, by this definition, are non-earning. They're termed here zombies, but basically, its financial performance is extremely poor, if not kind of almost non-existent. And you can see here the activity of these zombies, if you will, is significantly underperforming the S&P 500. So again, to my comment in the last slide about these factors that tend to outperform during these periods of slowdown, the quality factor is extremely well represented. Here's the S&P 500 against the Russell 2000. And so Russell 2000 tends to emphasize small caps. And so this is a factor that will come into play at some point, and we will want to emphasize and probably rotate some assets into. The timing is just not right for that now. When you have a slowdown, this is very emblematic of what happens. You have the S&P 500 index, which has kind of an 85% market breadth type coverage in terms of the market cap, if you will. But Russell 2000 typically represents smaller companies, smaller cap companies, and you can see here, particularly on that bottom chart, the relative performance has been rather negative to date, and would expect it to continue to be so until we get this increased visibility on the emergence of the new economic cycle. Here is a 3-month to 10-year bond yield spread. This is the U.S. Treasury. So you can see that we are down at a fairly low juncture. This number has continued to move down all year long. And I think really just kind of serves to remind us that the yield curve is quite negative. When you get these little flurries of enthusiasm in the stock market, and you have a pretty decent up day, then you look at something like this, and it reminds you, hey, listen, we're in an economic slowdown. You could have these bear market rallies. You could have, even as I said, stocks being up a year from now. I think that's entirely possible. But as it stands right now, we have low 10-year uh, 10-year yields, which have actually come down over the last month or so. And then we have these sticky short-term higher rates, even though the 2-year has come down. But 3-month is about as sticky as it gets, because it's going to much more closely mimic where the Fed funds rate is. And we do expect that to remain higher for a little bit. Here is the MOVE index. This is a measure of bond market volatility. And stock market has what they call the VIX. And so we look at that from time to time. And then we typically don't look at this index nearly as much, because the volatility usually stays within a reasonable band. And so here we have this gray shaded area represents 2 standard deviations. And you think about what that means is that you are going to have essentially 95% of all your observations are going to be within that 2 standard deviation band. And well, guess what? Last month, and over the last month, we've seen these readings punch right through that. We've had incredible bond market volatility, much more than we usually do. And you see that average there about 91, and we're well over 120. In fact, we're over 150. Again, we're outside that 2 standard deviation range. So this is, you think about it statistically, the volatility that we have in the bond market right now is really about a 5% occurrence. I've got a couple of educational slides, which emanated from some research that was done by David Blanchett of PGIM, as well as Ross Riskin, to give appropriate credit here. This first chart represents their analysis up through 2022, and you can see here they've got 2 iterations of this. It actually went back to really the beginnings of the S&P 500 index at the beginning of 1927. So 1927 through the end of 22 represents what they call their full period, and that's in the orange line there. And so just the observations from 2012 to 2022 are in that blue, and you can see here if you missed well, say if you didn't miss any days, your average return. This is price return, not total return, which would be price return plus dividend yield. But your price return over the last 10 years to the end of last year would be about 10.5%. Again, if you had remained steadfast, not succumbed to any behavioral impulses, so on and so forth. And then over the full period, that would have been closer to about 5.8. Again, you add dividend yield on top of that, then that gets you a lot closer to what the average annualized return is for the stock market. And then if you happen to miss the best 5 and the 5 worst days, then you would have had a slightly better return. We talk a lot about, like, if you miss the best days in the market, then you tend to really torpedo your return. But this presupposes that you're also missing the worst one. So it's a bit unrealistic, but again, if you stay out of the market and you just like miss the tail ends of the market, the research here shows you that you actually do fairly well. But the problem is, and this article wasn't intended to try to get people to time the market, it's just saying that there is a value in diversification over a long period of time, and that you're not necessarily hurt if you miss some of the worst days and the best days in tandem. The second slide of this particular research paper shows you the impacts if you had missed the 20 worst days, 10 worst, 5 worst, and then the 5, 10, and 20 best days in the market. So obviously you would have done much better had you been able to time it. uh, to where you miss the 20 worst days. And then obviously that goes down, and the data for none here is the same as we saw in the prior slide. So what we usually show you is on the right-hand side. So if you missed the best 5, 10, and 20 days, and you really torpedo your performance, particularly over the last 10 years if you missed the 20 best days. But again, this report is not, I just show it here to be illustrative, and as really, if anything, to be an emphasis on staying diligent, not trying to time the market, because it's extremely hard to do, and some of these trends move fairly quickly. News-driven changes, inflections in the market can be rather rapid. And I guess the point here is that you're just as apt to miss the 5 best days in trying to time the market as you are maybe apt to be lucky and miss the 5 or 10 worst days in the market. And it's very hard to judge that. And so it's just the point here is that remaining steadfast, you can better ensure, again, no guarantees, but you can better ensure a more consistent long-term return average. But the swings, if you try to time it, can be dramatic. Here we have a couple of charts on oil, and obviously lately we've had an announcement from OPEC Plus that they're going to curtail production. And how does that translate into prices? Well, the left-hand side from Bank of America indicates that we haven't had a big price change. In fact, we've had a fairly muted response net to this announcement, where you typically will have that price spike. And that indicates to some degree the fact that we're in an economic slowdown period, and that you're just not getting that. You've got demand destruction going on. Right-hand side from the World Bank, we've got oil price changes, and you can see here in these notable spikes, and in both cases they've overlaid recession periods. And so the takeaway here is that when you have these price spikes, it tends to correlate with a recession period. Now, not all the time. But here it would be consistent to think that oil price spike when we have it would correspond with recession. And in the case of the current environment, with prices really not reacting that way, it might indicate that perhaps that we were and have been in a mild recession and just don't really know it yet. The last few charts here in the pack this week, I'll focus on some things I thought were particularly interesting. This one relates to rents. So in the amber line there, we've got 3-bedroom structures. Rents remain fairly high. And then in the blue line here, we have 1-bedroom apartments, and we see the rents are trailing off here. And we know, as this all kind of indirectly translates into owner's equivalent rent, and how it filters into the consumer price index, we do see that larger structures, we see rent kind of attenuating its rate of increase, but it's not necessarily going down. But these smaller units are clearly moving lower. I thought this was particularly interesting. This is some data from the NAR, National Association of Realtors, and this is a number as they calculate it. A number of members of the NAR as a percent of the U.S. labor force. And think about all the real estate agents out there, and think about where we were before the global financial crisis. We were at 0.9%. We were actually almost close to 1% of the U.S. labor force involved in membership with the National Association of Realtors. That is just astounding to me. That has obviously trailed off with some weakness in the market. But I thought this was really, really interesting. And in our last slide, I thought I would show this one. This is manufacturing unit labor cost per hour in China. And you can see kind of this meteoric rise over a number of years here. Not, again, didn't happen yesterday. But as we think about China, we think about this trade war, we think about the new Cold War with China. You think about manufacturing and the cost competitiveness that China always seemed to have in manufacturing, and how that really has changed. There is some automation that's been introduced into this, which has taken the labor component out of it, out of manufacturing in many cases. But as you see here, Malaysia, Thailand, India, Vietnam are have increasingly become much more competitive in terms of their labor cost unit per hour. And with that, I would expect to see, and this is a chart that was in the Economist magazine, expect to see the trend of moving manufacturing away from China into these other areas just continuing to evolve. All we have for this week. I hope you've enjoyed the chart pack. I hope you have a wonderful week. Talk to you again soon. Take care. Bye.